Okay, what's up, everybody? Jay Martin here, CEO of Cambridge House. And my next guest is Robert Kientz, the founder and editor of GoldSilverPros.com. And Robert and I jumped into all sorts of assets we covered gold and silver, of course, and the variety of ways that investors could approach that market, should approach that market, how he approaches that market and holds gold, silver, and the equities in his portfolio. He's also a big investor in Farmland. And so we got into how he executes as an investor in Farmland. And he goes ahead and buys operating farms and operates them. So a bit more involved than I'd like to be, but it was fascinating getting his perspective on that. We talked real estate, Bitcoin, and a variety of things, including the broad equities market, his forecast for the lifespan left in this equities market rally, if you want to call it that, and what he thinks the aftermath is going to look like, which I know is a big question on my mind and a lot of your mind. So I wanted to make sure we covered that. Now, this is a really fun conversation. I really enjoyed having Robert on. He's fascinating. And I think we'll have him up to our conference in Vancouver. We're bringing back our Vancouver Resource Investment Conference this January 16th and 17th, finally back to the physical form. This is our flagship commodities investment conference, over 8,000 investors, close to 300 companies, 80 to 120 keynote speakers. It's a beast in Vancouver, British Columbia. Absolute blast to produce. If you want any info on that event, right beneath this video, there's a pinned comment where you can subscribe to my weekly newsletter, where I debrief conversations just like this and plenty others, and update all of our subscribers on our conference calendar as we get back to it. The Vancouver Resource Investment Conference is coming back and I can't wait. Okay, Robert Kientz, Gold Silver Pros. I hope you enjoy this. If you do, click subscribe, turn on notifications.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Robert Kientz, the founder and editor of GoldSilverPros.com. Robert, how are you?
Doing very well, Jay. Thanks for having me on.
Yeah, thanks for making the time. I'm excited to chat with you and get you in front of my audience, learn a bit more about your business, how you operate as an investor, what's catching your attention, all that fun stuff. Hopefully you can help me make some money. It's been a very expensive summer over here, so I'd love some assistance. Let's start with, because I haven't had you on the show before, could you just give us the opener, Robert? Gold Silver Pros, what do you guys do?
So as the name suggests, we do education services for gold and silver. We run a newsletter. We do video content. We have sponsors that sponsor our channel as well that want to get their message out to investors. As you know, Jay, the gold and silver market, the resource market is not one that's typically the darling of the mainstream media and the mainstream media outlets. So it's really up to guys like us and our individual outlets to put out content and share that information with people and build the communities. And that's basically what we do.
Got it. Okay. Yeah, it's not usually a point of mainstream conversation, but it has been a couple times this year. Mm-hmm. And specifically maybe 13, 14 months ago, right? This is really peaking. And it's since cooled off. Were you surprised with, we're sort of a year, we look at the gold performance over the course of a year, we're pretty flat, some big ups and downs, but we kind of started where we finished where we started. Are you surprised by any of that, Robert? And what's your take on how the last year has performed?
Well, I would have expected gold and silver to do a little bit better. I think, we're just sort of in the middle of the summer doldrums, which happens to a lot of investment markets, especially gold and silver in June, early July, and then they tend to recover as we get closer to the fall. So it's typically, June's one of the worst months for gold and silver. So we gotten out of there. We're going to get into the seasonality and the Asian demand here in the late fall. So I think we'll have a nice price recovery. But I think people are aware of the macroeconomic factors in which you would want to invest in gold and silver. But right now it's, I think people have the rose-colored glasses on. They see a really strong stock market. They don't see any major issues in the economy. We've had, I guess, a somewhat successful restart of the economy, even though not all the jobs have returned. The government really is basically putting out a lot of money for people that are unemployed. So a lot of people really aren't feeling a lot of economic pain. And in that case, you're going to, tend to have sideways trading gold and silver prices.
Yeah. Okay. Now those doldrums that you talk about actually get me really excited because that's when I like to start making sure I have a war chest ready. Right. Mm-hmm. And when markets heat up, it's too late. So, Right now, I'm actually very satisfied with my gold and silver portfolio. I've got a bunch of great names in the holding, and I'm very content to just sit and wait. I want to talk about a couple things that you mentioned. Three really that stood out to me were the Asian demand for gold coming into that seasonality. I'd love to dive into exactly what that is, and then we'll get into the equity sentiment and monetary policy, all this stuff. But talk to me about the seasonality of Asian demand and what that is.
Yeah, so essentially Indian culture, Southeast Asian, Chinese cultures really have a lot of gold imbued within their practices and customs. So weddings, fall celebrations, usually people are adorned with their gold, and in some cases silver. India's a really big market for silver as well. So we tend to get that Asian trade, a lot of demand there. Of course, the demand for investment grade gold and silver is very strong in Asia right now as well. We want to talk about the Chinese central bank have been buying it hand over fist. Russia's buying it. So that part of the world, the eastern part of the world definitely favors gold and silver from an investment perspective and from a ceremonial perspective. So we're going to see that tick up in the fall. We typically do. Usually that peaks somewhere around in the December timeframe. We'll also see some additional demand for gold and silver in the U.S. in the December timeframe because of the holiday season over here as well.
Yeah, Frank Holmes calls that trade the love trade. Mm-hmm. And he actually claims, I don't know how you verify this, that 50% of gold demand is created by the love trade, which is the jewelry market, right? The wedding season, right? In Asia, as you just described it. Okay, thanks for adding some perspective and context to that. Now, yeah, rose-colored glasses, looking at the equity markets, I'm completely on board there. I have no positions in the broad equity sector, wouldn't touch it with a 10-foot pole personally. It's just not my style. Yeah. What are investors missing right now, Robert? When, because you can look at the equities market and say, look, it doesn't matter if it's overvalued and crazy and doesn't make sense. The Fed's not going to let it fail. So would you agree with that? Or when you hear someone say that, what's your reaction?
So, yeah, I see what people see there because the Fed won't let the equity market fail. The equity market has, because of mainstream media and culture nowadays of the investment class, the passive investments, everybody wants to get into passive equity investing. That's where most of the fund flows go. And it benefits all of our corporations because it gives them, money inflows so that they can, spend OPEX and CAPEX. So it's nice when that's going very strong. However, when it crashes, when the system needs a periodic reset due to the business cycle, which it does, it tends to crash bigger when we've blown up these big bubbles. And we have. A lot of the money printing from the Fed in the last few years has gone to the stock markets. Now, however, we're starting to see some money creep into the commodities markets, and it's raising prices. So you're seeing higher inflation prints like the one we had today, I think 5.4%. So a lot of that money sloshing around that the Fed has been printing to support, the markets, make sure that the companies have fund flows, is now starting to move into end products and prices. And the question is, are we getting into that high inflation period where your stock portfolio is not really going to protect you because you're dealing with high price inflation and higher living expenses?
Got it. And in one of these periodic, first of all, do you have a time horizon, Robert, that you're considering? Wouldn't ask you to call it. That's silly. But, a periodic reset, I completely agree. That's why I've got no cash on the table, no skin in the game in the equities market. Do you have a time horizon in your mind that makes sense to you that this game could go on for this long, but probably not that long? And what's the aftermath look like?
Well, I would say this: value investing is dead, not because it's not valuable, but because no companies anymore, you look at Tesla and Apple, they don't trade based upon the net asset value of their companies. They trade based upon people putting money into Robinhood and passive index funds and their 401ks and that bidding up, the stock prices. So this can go on. There's a famous saying, markets can stay irrational longer than you can stay solvent. It's very difficult to call when this is going to happen. Typically what happens is the bond market will start to go first if we're talking about a big correction. Like, look at 2008. You had the mortgage crisis and the debt crisis, which then led to the eventual crash in the stock market. So pay attention to the bond markets. When those start to experience trouble, when you start to hear about potential bank failures, that's when you know that you have an impending correction in the stock market. The only other thing that typically causes a correction in the stock market is Fed tightening. Now, the Fed in recent meeting minutes in June said that they hinted that they may tighten, that they're satisfied with the inflation they're now getting. They're satisfied with the economic growth. They may tighten later. The problem is the last time the Fed tightened in quarter four 2018, we had 20% stock correction. So the Fed has to be super careful, and they're kind of put between a rock and a hard place. Do they support the bond market or the stock market? And that's going to be a tightrope that they're going to walk. I think Powell and the Fed knows that. So they do a lot of jawboning the Fed meeting minutes, but I'll be surprised if they start to raise rates this year. So I think at least this year, we're not looking for the big pullback, but I do think eventually it will manifest, but I think it's going to manifest because of problems in the debt markets.
I'm with you. Okay, now, Robert, why is the bond market the leading indicator that so many investors point to?
Well, bond investors, I think, are smarter in general than stock investors. They do more homework, they do more research. And generally, there's a lot more information that goes into people that invest in bonds and the pricing of bonds. And so I think that essentially when you see trouble in the bond market, you're going to see it everywhere else. And in our fiat money system, we have excessive debt. There's excessive debt at the corporate level, the personal level, the sovereign level. We're at all-time highs. So that's where the problems really got to start. In other words, when companies can't pay back the interest on the debt, that's when they're going to have issues with their stock prices, because it's going to manifest in their earnings reports. When the United States or other nations who are overly indebted, let's say inflation goes up, Fed raises interest rates, makes it harder to service the debt, then you're going to start to see some issues in those debt markets, and it'll lead the way, and then eventually you'll have that correction in the stock market.
Got it. Okay. So thank you for that. Now, based on everything you've shared, I could guess probably your perspective on some people's claim that we're going to enter the roaring 20s here on the back of a vaccine-led recovery, all this pent-up demand, yada, yada, yada. How on the money is that statement, Robert?
I think we could, because you're looking at commodities markets exploding right now. You had the base effect return, but we're now past 6 years of data in the commodity markets. We've set a new 6-year highs in those indexes. And those are starting to manifest in the PPI and in the consumer inflation. So we are going to have a roaring economy. I think the Fed's going to continue to support. I don't think they're going to tighten all that much. I do think you're going to have another upward explosion in the stock markets. I think you're going to end up with a classical Austrian crack-up boom eventually, where things get so expensive that there has to be a deflationary episode in the economy because consumers are 72% of it. And then you're going to have the Fed come out and print their last probably big print in this monetary cycle. All of that's probably going to take some time. So I'd give it a couple of years. I would aim for, the next big financial reset to occur probably 2023 timeframe, maybe 2024, depending on how long they can keep it propped up. But
when you say financial reset, you mean one of these periodic crashes, like a decade?
Yeah, a clean out crash, basically, like we had in 2008, although they didn't allow it to actually clean out. They kind of propped it up and bailed it out.
Yeah.
But I think we will have one of these clean out crashes coming up. And I do think that'll happen in a couple of years. And I do think it's going to force the Fed's hand as well with the money printing.
Okay. And when that occurs, what do you think the recourse will be for the US dollar as the world reserve currency? How could that shift or evolve?
Well, okay, now this gets really interesting. If you followed my channel, I've done a lot of research on the IMF, the BIS, the central banks. They're going to go to CBDCs, the Central Bank Digital Currencies. They know that a lot of the currencies, they're not backed by gold anymore. The fiat currencies do have a life cycle throughout history. I mean, you look at any country, including the US, you look at the currencies printed during the Civil War, and all pure fiat currencies eventually end. So they know that. They know that the debt markets are going to have trouble. They want to replace the system with central bank digital currencies. We have the euro trademarking, the digital euro. China is leading the way. On CNBC yesterday, and I was talking about this on an interview with another channel, they came out and said the BIS and China are leading the way in central bank digital currencies, and they're building systems to enable all of the national digital currencies to talk to each other. So that's the next system. So whenever we get into the next big fiat currency crisis, the dollar crisis, I think it's also going to be a euro crisis. I think it'll be a yuan crisis. I think they're going to roll out the central bank digital currencies and change the system. The IMF reported on that in 2015 in about a 50-page position paper. So this is what's in the plans. Of course, it all has to play out. I think the dollar still has one final hurrah here. before we reach that point. But I think we're going to get digital dollars after this next financial reset.
And when you think about that scenario, the digital dollar scenario, tell me about the major impacts, the everyday investor, consumer feels. How does their life change in that scenario?
Well, usually when that happens, when you're changing when you're changing the base currency from one thing to another, they devalue the older currency in favor of the new one. So they can have that pressure taken out of the system. Think of it like a pressure cooker. They got to take the lid off, right? They got to let that steam get out. So that's what they do. They revalue the currency. So the central bank digital currencies, if you have $100, maybe you have $50 in CBDCs or 25 or whatever that revaluation is. And again, that's in the IMF paper, by the way. They outline the mechanism for how that would work. So if you're heavy into cash, if you're heavy into dollar denominated assets, expect a revaluation of that asset. As to what that will be, we don't know. It just depends on, the circumstance of the problems, whether it's limited to certain nations or whether it's more of a worldwide thing, given all the debt that's sloshing around worldwide. So I think, there is still some questions to be answered, but I would, what I have done is gone defensive and gone gold, silver, farmland, certain other assets, I think that will do well in a reset scenario in which you'll have a revaluation of a currency. But leaving yourself in cash could be potentially the most dangerous thing.
Okay, now interesting. Now, just to pull on that thread a bit more and go further down that path, what could you speculate for me on things like government intervention and involvement in our income, in our taxation, when we're utilizing a central bank issued digital currency, when it comes to things like transparency and controls, all of this?
So yeah, the government's always going to protect their currency. We look back at Rome, and they protected the denarius and the other coins, even though they were debasing them. They try to protect it. They'll do whatever they can to protect, the currency of the nation, because currency of the nation is how they essentially operate. And it's also how they keep people from rioting. They keep the people from starving is to issue currency. So essentially, they're going to protect the system up until they can't protect anymore, and they're going to switch it over. And it's going to happen overnight. What happened in Germany was you had millionaires and billionaires waking up on a Monday morning and their bank accounts had been revalued, and they were no longer millionaires and billionaires. And they were the merchant class, if you will. So it's going to affect anybody that's sitting, heavily in currencies. So being able to prepare ahead of time for knowing what's going to happen, how that's going to happen, is a wise course. Again, I wouldn't sit very heavily in cash.
Okay, and leading up to that event, because I try to sit heavily in cash because it has utility. If I have enough cash, I have the confidence then to go big into the speculative sector where I like to play. Yeah, and obviously to capitalize on any crisis scenario. I want to have some shells in the clip, but. The indicators I'll look for will be, to your point, that final hurrah of US dollars, which relative to other currencies is how you'll know, right? And US dollars probably will be the last to crash. Would you agree with that?
Yeah, I think the dollar is going to explode upward at some point. I think you see the stock market explode upward. Like you said, you could have a roaring 20 scenario where everything's going up until the point at which it doesn't. And you get your Great Gatsby moment, where all of a sudden you're like, okay, that ended with a nice pop. My parents lived during the Great Depression, and my father was in World War II. As a result of that, he was a naval officer and landed on D-Day, did that whole thing. So they grew up during that time in which we had that great big explosion, and then everything crashed. And thankfully, I was able to learn some lessons from them on how you manage that situation. And it's okay to speculate. I've got no problem with people speculating whatever they want to speculate in, stocks, cryptocurrencies. I used to trade Forex. I used to work for a Forex broker, and I would trade on like the 1 and 5 minute charts on a highly leveraged market. So I've definitely been there in terms of being a speculator. But when you're going through fiat currency regime changes, you kind of have to be careful and make sure that you're protecting yourself there. If you're going to be in speculative assets, make sure you're liquid and you can get out of it if you need to. Yeah. And just balance your portfolio with things that tend to establish value over long periods of time, like gold, silver, farmland, other physical, tangible assets, maybe rental property to some extent, things in which people are going to use, which are always going to have value. Therefore, you're not overweighting your portfolio on one end or the other.
Yeah, 100%, 100%. And you know what? Aside from maybe the cash bucket of my portfolio, we're probably not too dissimilar. I don't own farmland, so I want to ask you about this because I'm very split in the barbell philosophy. I have cash, gold, real estate over here, and then very early stage entrepreneurs, which I back over there, and that's my speculative bucket. Talk to me about how you're positioned in farmland, Robert.
So I live in Texas, and we have great seasons for growing crops. But what I grow is not crops. I actually grow hay, and then we harvest the hay and give it to the local farmers.
But you own an operating farm. You're not buying an ETF or something like that.
No, I actually own physical land. For about 18 years in Dallas area where I live, I had 2 real estate investment businesses, and I ran a lot of rental properties. In fact, I was an investor. I was a landlord. I rehabbed them myself. I built those companies from the ground up. And got into real estate, realizing the rental market probably was going to overheat a little bit. So I took profits from that and went into farmland. The great thing about farmland, in most tax jurisdictions, especially in the United States, you can get favorable taxation. So I basically pay very little in taxes because I'm producing a good, which is an agricultural product, which helps the economy. So I have a very, very low tax. I think I pay like less than $100 in taxes every year on all the farmland I own. And because we get something called the ag exemption. So it's a low tax basis. You basically are getting to carry forward almost tax-free your capital gains in these investments until you sell them. The great thing about land too is you have all these ways to pass it on to your heirs on a step-down basis or do like an exchange via IRS rules into another investment. So real estate is one of the things, if you play it right. Robert Kiyosaki always lectures that more people have been millionaires in real estate than any other investment over time. And you can do that in farmland, believe it or not, if you hold it long enough. And if you do it right, it's ultra safe. The thing that's probably safer than gold in a crisis is farmland, because we always seem to be growing in population. We always seem to need more food. We always seem to need more, you could turn the farmland into a business building. You could develop on it. So it's almost like one of the least risk assets. But for me, to reduce counterparty risk, I want to get rid of taxes. So I do the farmland. You can do commercial buildings. The problem is right now with the pandemic we had, commercial is not a hot place to be right now. We've got an overbuild of commercial. So that's why I stick with the farmland. I could hold that for 100 years. I could will it to my children, and I wouldn't really ever worry about it. And we're going to have a nice tax-free almost appreciation of value.
Yeah. No, I feel like I lack the sophistication to enter that market in the way that you have. Just having zero background, my garden's a disaster. My kale does well, other than that. So is there a path, Robert, for the inexperienced investor? How do they get a piece of farmland into their portfolio?
You could do a REIT. I'd be careful in the REIT, make sure they're not mixing different types. And I don't know how many farmland specific REITs there are, but there probably are some. Another way would be to find a local real estate cooperative or investment group where you can be a passive investor, not have to manage the investment, but you're just a money person. You put money in. Of course, you have to have a lawyer involved, making sure the contract stipulates all the protections you need, but you can do it that way. You can be a passive investor. In Dallas-Fort Worth, there are several real estate investment groups which will allow you to passively invest and other people manage the money for you. And they're well established, well trusted. Investors generally like them and tend to do well. So if you want to learn how to take care of the land and take care of the tax filings and all that stuff yourself, you can just put some money in and take a piece of the profits.
Okay. Let's move back to precious metals. Talk to me about how you're positioned, and I suppose how you're communicating to your readers and your viewers how to position themselves for the next few years. What do the portfolios look like?
So surprisingly, this is a very complicated topic. You think gold, silver, precious metals, you think easy, but there's many ways to own it. I'll talk about the ways I wouldn't own it right now first, and then the way I'm positioned. So I wouldn't own anything at Perth Mint because Daniel Vigario, a CFA based out of the UK, and I'm a former auditor, went through their published audited financial statements and found that they're running a fractional reserve metals scheme. It's an unallocated scheme. And if there were ever a run on the metals at Perth Mint, not only would they not have the metals, they wouldn't have enough cash to buy people out because they're financially, leveraged short. So you have to be careful if you're going to buy unallocated gold, silver, if you're going to store it somewhere, You have to read the fine print. It has to be completely legally in your name, completely allocated. And you may want to make sure that you can get it delivered. Some schemes where you store metal will charge you upward to 10 to 12% to ship your metal back to you. That's very expensive. So that's a way in which you can hold it if you want to be passive about it, but you're going to pay a cost in one way or the other. You're going to either take counterparty risk on price exposure and a net short position not having enough metal, or you may pay excessive fees to get the metal actually delivered to your door in case you ever wanted them. So that's the way I wouldn't do it. I also wouldn't go into GLD or SLV ETFs for gold and silver, because if you read their prospectuses, they basically say we guarantee nothing. The custodian's going to run off with the metal and we have no recourse. We don't audit the custodians, and you don't have redemption rights in the metal unless you own 50,000 shares or you're an authorized participant, which is one of the bullion banks. So those aren't really great ways to do it. A lot of people do it that way in their portfolio, but it's a dangerous way to own the metals. The way I own the metals is a couple of different ways. I do the bullion, the typical bullion products, probably about 60% of my portfolio.
And when you say bullion products, you're talking about bars and coins, physical in your
bars and coins, especially sovereign minted coins like the American Eagle or Canadian Maple Leaf, something, South African Cougar Ant. That's kind of the safest way. They're low premium products. You can get in. Well, right now they're sort of high premium because of demand. There's so much demand for physical precious metals, you're going to pay a premium, but typically it's fairly low. And you can own it. Price appreciation over time is very solid. The precious metals, the physical, have beaten the tar out of the stock market since 2000. If you look at that chart, I think silver and gold both have doubled the S&P and Dow since 2000. So if you're a generalist stock investor, you would have been better off the last 21 years holding physical precious metals. In fact, you would have doubled your gains. I also own numismatics, which are collectible coins. They actually, believe it or not, that market tends to be more stable even than the bullion market from a beta perspective or a price fluctuation perspective. You kind of have to have a little bit more knowledge about what you're doing, but there's plenty of knowledge out there and plenty of conferences you can go to educate yourself. I used to only have about 10% of my portfolio in that, but the last 3 years that's exploded. And so the value of those has increased so much that it's actually gone to about 30%.
And do you
just in price appreciation? Yeah.
Do you rebalance in that scenario?
I'm not. I'm holding on to those coins because I'll probably just add more bullion, to be honest with you.
All right.
To rebalance it that way. And then the third thing is mining stocks. Mining stocks are highly speculative. It's hit or miss with those. I mean, for every 5 or 6 you invest in, you may get one that does really well. So, a word of caution there. But the leverage on those investments is incredible, especially when gold and silver are going up. And I think they're in a bull market. So there was a point in time when silver ran to $50, where a lot of these junior silver miners, went up by a factor of 30, 40 to 1. So during times of really big bull markets in which gold and silver are hitting all-time highs or new cyclical highs, that you get incredible returns in the precious metals market. But again, it's speculative and it'll go against you 90% of the time. It's only in your favor 10% of the time.
When you talk about mining stocks, are you talking about the majors, the producing companies that own mines and are extracting metals, or are you talking about the development companies, the exploration stage? What stage in that business cycle do you focus on?
A lot of the money managers will go into the bigger ones because most gold and silver mines are relatively small. There's about 800 or 900 of them around the world. They all have relatively, small balance sheets compared to a big stock like a Tesla or an IBM or Microsoft. So most of the major fund managers go into the big ones like Newmont, Barrick, those guys.
Yeah.
However, what happens is they're selling a disappearing asset because you're selling ounces in the ground and it's harder to find new ounces than it is to dig it up and sell it. So a lot of majors right now, and Rick Rule will say this, he's one of the prominent commentators on the market. Right now, the majors are having a hard time replacing their mined ounces, to keep that balance sheet up, to keep it favorable for their stock investors. And they're having to pay more and more per ounce. Gold and silver are getting a little bit harder to find. Right now, the sweet spot for me is a miner with an exploration company that's making a mining decision that has an established deposit in a technical report, what they call 43101 report, that outlines their what they have and the value of that and estimates the cost and gives you like a potential net present value of that project. So from accounting terms, you can figure out what it's worth. And they're about to make that mine decision. That's probably the safest sweet spot to be. I will say that there aren't a whole lot of those companies right now. I could probably count 10 to 15 to 20 that would be worth investing in, but they tend to do very, very well. And it tends to return at least 90% of the time in that case. So it's a pretty safe investment. You could go exploration. It's much higher risk. The returns could be fantastic, but it's much more of a hit or miss situation. So basically going with the explorers, you could have 10, one does well, and you do very well, but the other 9 could completely bust.
Yeah, you're looking for that asymmetric bet. The most you could lose is 100%, but you're looking for that 5x plus return.
Yeah, you could get that 10 bagger, which makes up for it.
You could. Yeah. Easier said than done. And so do you play in the exploration market at all, Robert, personally?
I do. That's a speculative event in my portfolio. Instead of trading currencies and regular stocks now, I do some speculative investment in the mining stocks, and I run a newsletter in which we talk about some of the mining stocks as well for people who want to pay for a subscription to that. So we do cover that sector quite a bit. I've been writing on that at Seeking Alpha for about 12 years before I started Gold Silver Pro. So I do have quite a history in covering that market.
So give me a bit of insight then for non-subscribers. And I won't ask you to talk your book because it won't piss off your subscribers. But give me some, because we all have different criteria. I'm personally a very people-driven investor, not a geo. I know people though very well. That's what I do. I talk to people for a living, and so I feel like that's my gauge, that's my edge. And how do you approach the exploration market? How do you cut out the 95% that aren't worth your time, energy, and money?
Well, I'm going to edify what you said, because when I first started, I looked at the deposits and I looked at the ounces in the ground, and I tried to get very analytical about it. I have an analytical background, 25 years in technology. And then I realized, well, that doesn't always work. And what I found out was a lot of the greats will teach you, in the mining industry, to look at people first for 2 reasons. One, because management teams can take mediocre projects and make them run well. But if you have a bad management team, you can really hurt a really good project.
Yeah.
So the people and the management matter. And as Rick Rule says, you want somebody that's been successful more than once. He calls it serially successful. The other reason people matter is because of networking effect. The mining companies that get the best network effect are going to be the ones that get the money. And so you want to be in one of those companies that gets the money. I've seen plenty of miners have plenty of fine projects, and they just sit there and they don't trade up because people are simply not aware of them. And they can be great projects with great management and great ounces in the ground, but they just don't go anywhere until somehow they catch fire. And I've also seen explorers with no known assets IPO, and triple in price with no known assets, because the management team, people expect them to do well. And because they're well marketed, they'll do very well even when they're first starting. So mining is very much a people business. 100%.
And there's so much in there, so many threads to pull on, because to your point, C-level management team with a AAA asset can still sink that and do nothing with it and sit on it for 10 years.
That's right.
And just, absolutely blow the opportunity until somebody more competent takes it over. And I've seen that occur. Mm-hmm. I'm the same with the people-driven approach, because in theory, if you get that part right, the rest should take care of itself, right? Mm-hmm. They'll have the technical team to vet the asset. They'll have the plan C when plan A and B fail. They'll attract other quality people to the team, have a cheaper cost of capital, all of this stuff. Okay, now, how do you determine, because what I tell investors is it's not about picking winners in the exploration market, because that's just really, really hard to do. But what you should work to do is cut out the losers, right? Mm-hmm. And that's more important, because often the loudest, most promotional, in-your-face stories are not worth your time or energy, but they raised $2 million and they spent half of it on marketing, right? And so do you have any rules, Robert, to identify red flags? If you have I'm sure you look at lots of deals. So say you got 30 on your desk, you're looking at this month or however many. Do you have some hard and fast rules to just exit decks off of your desk so you can say, I know I'm not going to waste any more time on this. I can move on to the next?
Yeah. First, I do look at management. If I'm not comfortable with them, and then they're not a mix of business acumen and technical knowledge, I pass.
Right.
Because probably what they are, or either promoters or they're first timers, or they're trying to develop something without the expertise, and they're going to get lost in the process. Navigating an exploration and mining company is one of the most difficult things you can ever do. It's surprisingly difficult, and having the right people matters. You also, it does make sense to pay attention to jurisdiction. You want places in which the local governments are going to be friendly to miners and appreciate the value that the miners bring, so that they don't tax them to death or put roadblocks in their way to get permits and stuff like that. And you also want, probably from a technical perspective, the first thing I look at is where are you mining? Are you in an established belt? Are you in an established area? Because if you're in an established area, your odds of finding an economic deposit and actually making something of that with good management and good stewardship go way, way up. If you're out in the middle of the boonies somewhere and you're like, man, we think we found, the lost Mayan gold and nobody's ever, looked at it, but we're sure of it. Those are the types of things I stay way far away, because it could be a home run, but at the end of the day, you're literally taking 100% risk with your money in that situation. And I'm just not comfortable doing that. I really look for things in which I can look at 2 or 3 factors and say, okay, I see some potential success factors there. I might enter a position and see how it goes. Put a little bit of money in, don't go too strong into it. That way, if something stops it, it's a local jurisdiction or it's more expensive to get that gold or silver or base metals, or management just flubs it and they don't do a good job, or it's not marketed well, you can get out of your position. So it's not only how you look at the deal, but how you get into the deal that matters. You need to be careful of putting yourself in. You want to stair step in and pay attention to that company and look for that success. If you're not seeing it, take your money out and go invest in something else.
Okay, now you touched on jurisdiction. It's the one thing we haven't covered yet. Given the last 15 months, we've had crazy volatility, more than I've ever seen in my lifetime from a global standpoint. And I think the repercussions are very much unknown what we'll see in the future. Are you more focused on jurisdiction than you've been in the past? And how disciplined are you now when it comes to things like risk of nationalization or super taxes on resource companies, all this stuff? Is it front and center for you and it wasn't a year ago, or has this always been key?
It's more front and center, although I don't X out a company because they may be in a higher risk jurisdiction, but I look at them very much more carefully. So a few years ago, Freeport-McMoRan had one of the biggest copper deposits in the world, had some gold in it out in Indonesia, the Grasberg mine. And Indonesia all of a sudden just changed the rules on Freeport and required them to spend more money on developing the local resources, pay more. Freeport got less out of that deal than they originally anticipated, and the stock really kind of got blown up there. And that can happen. As it turns out, it's still a pretty good deal for Freeport. They're still going to make money. Stock investors are going to be okay. But it blew up the stock because the local jurisdiction, and I think fairly so, decided that they wanted to get more of the value of that resources into the local economy. Most mining companies have gotten savvy about that, and they've hired a lot of local personnel, and they work with the local jurisdictions to facilitate that relationship. But all it takes is one bureaucrat or one of these non-governmental entities that wants to claim you're harming the environment, and it can blow up your entire proposition very quickly. So jurisdiction does matter. You have to pay attention to that. If you're going to get outside of some of these, what we call tier 1 jurisdictions, then you just have to discount the value of what you think that is. So if you think the stock is maybe a $2 stock, maybe you discount it down to your price target's $1.25, and there may be more risk or more time to get there. That's kind of how I do it. I just kind of draw down on what the potential could be. And then I don't have too many of these in my portfolio. I'll pick strategically ones that I like. There is a silver miner in Peru that I like a lot. I've spoken with company management. Even though they had a very left-leaning election in Peru, that government has said, we're not touching the mining sector because you guys bring us a lot of money. So I'm okay with that risk, but you have to be careful because things can change very quickly.
I'm with you. Okay, interesting. Yeah, Peru's obviously been a hot topic on my channel over the last 2 months, but I'm with you. I think that there's been a lot of noise and sensationalism and fear-mongering about the new sitting president, but I don't think it's nearly as consequential as it could have been. Time will tell if I'm right, but yeah, I don't know. I have put my money where my mouth is on that one, so we'll see what occurs. Okay, Robert, we've talked about gold, silver, real estate, farmland, dollars. What's left? Do you hold any Bitcoin?
I don't hold Bitcoin. Here's my explanation for that. And it confuses people because I'm a tech guy. I've got a master's in information assurance, which is cybersecurity. I have a bachelor's in management information systems. I was in the IT field for a very long time. And people are like, why are you a gold, silver guy and you don't invest in crypto? And here's the reason why. The cryptocurrencies in and of themselves, the coins really don't have inherent value. The blockchains in which the coins ride on have the value. They're the ledger, they're the transport mechanism. They provide the value of being able to ship a coin very cheaply across the world on these electronic networks. The coins themselves aren't like gold and silver. Yes, for the ones that you're spending a lot of money on energy to get the coins, people think that that gives it value just like it does gold. But the difference between a crypto and a gold is you cannot destroy gold. It's literally impossible. You can bury it, you can hide it, you cannot destroy it. It's a non-destroyable metal. You can very easily destroy anything on a computer system. You can tear down that computer system, you can lose the key. And the thing about crypto is once you lose the key and you don't have, if you haven't set up a recoverable key or you lose your recoverable key, that's gone forever. You can never get that back. So there are a lot of risks to crypto. There are other problems with crypto in which they don't scale very well as actual currencies. About 85 to 88% of Bitcoin transactions are speculative bets. They're not coin transactions. And this comes directly from the mouths of people who are Bitcoin's largest proponents. We had a little bit of a debate in a fun video we did with Kurt, who's the chief historian over at CoinGeek. And we were talking pros and cons. You know, he like me was an Austrian economist, a gold guy, and he went to Bitcoin. And we were talking about why I went to gold and why he went to Bitcoin. And it was just a fascinating conversation about how you can see Bitcoin and gold different ways. But in that debate, he wasn't able to answer questions about, you know, why you couldn't outlaw Bitcoin, why Bitcoin actually has true value in of itself, why Bitcoin can't scale, things like that. The thing about Bitcoin's a lot like the internet. It's not very great right now in terms of providing actual value. Could it be some point in the future? Sure. But when we first got on the internet, we were dealing with, computer modems and unreliable networks and a lack of standardization. And it's taken 30 to 40 years for us to build a really robust internet. I think the cryptos are going to take a while to build. And I think along the way, again, going back to CNBC article I mentioned earlier, the BIS and the central banks and the Fed and the Treasury, U.S. Treasury, are saying we need to get rid of Bitcoin. It's a competitor to the central bank digital currency. So I also think that in addition to all the problems with the early cryptos, there's a war coming between the sovereigns and the private crypto holders. And that's going to, it's going to cause trouble for people that hold Bitcoin as a speculative investment. If you're holding a little bit to be like a backup currency, or it helps you to send money internationally to help, family members, cheaper than a wire and it's quicker than a wire, I get that. But if you believe that Bitcoin's not going to come under attack and that it actually will turn into a legitimate decentralized currency right now, I mean, it's just that's not in the cards yet. We've got a long way to go for Bitcoin and Ethereum and Litecoin and all those others to get to that point.
Yeah. Okay. I'm with you on that last point. I do hold Bitcoin and I don't trade altcoins and all this stuff. I just want a horse in the race in case Raoul Paul's right, and this $2 million. But I see the case for it. And I absolutely understand the value. And I understand it enough to have a horse in the race anyways. And when it comes to things like, yeah, you can lose your keys and your Bitcoin's gone forever. Absolutely. But that's on you as an individual for mismanaging your portfolio. The same as if I left my gold bar on my doorstep and it was gone the next day, it's gone for good, right? Mm-hmm. Somebody walked away with it and I can't get it back. And in terms of destroying it, I think the decentralized network effect is very, very robust. And I think that we've, in the last 10, 15 years, really started to understand the power of network effects on the back of social media platforms and everything else. When you just have this mass adoption, it's very hard to destroy. Powerful governments could put very inconvenient regulations in place, and then sure, game theory would apply. And maybe, yes, you can go to a place like El Salvador and hold Bitcoin tax-free, whatever. But how many people are really going to do that? And so when you get into the sovereign war on cryptocurrencies, that's where I'm completely aligned. And I'm like, we don't know what that's going to look like. But you know that no global superpower has ever just happily relinquished control of their reserve currency. It's never happened. It's never going to, right? So
they definitely don't want to do that. So it could be that the private cryptos win the day. I actually wouldn't mind if they did, because at least it wouldn't be in the hands of the government. It wouldn't be a government tool. But I just think there's a long way to go before we get there. It's basically an unproven platform. But because I have that tech background, I'm a little bit harder to convince. Probably if I knew less, I'd probably be a little bit easier. But we'll see what happens. I do think they're here to stay, though. I do think cryptos are here to stay in some form or format. I do think that there needs to be a lot more development before we get to what somebody would consider a legitimate decentralized worldwide currency, an actual currency. I think we're a ways away from that.
I agree with you there. Okay, Robert, look, what haven't we covered that investors, anything else you want to point to? Obviously, goldsilverpros.com for all of your content.
Yeah.
Tiers of content access there that people can check out. Anything you want to leave my audience with?
Yeah, we have a free newsletter. You can sign up at goldsilverpros.com. We just do notifications when we do stuff for free on the channel, do YouTube videos. We're having a virtual conference coming up August 19th and 20th. It's going to be the second annual Money Metals Summit, getting our speakers and sponsors lined up. We will also have a private deal room for those accredited investors who are interested in that as well.
The Money Metals Summit, August 19th and 20th.
Yeah.
Awesome.
Coming to a computer near you.
Coming to a computer. I love it. You know, I'm looking forward to getting back to physical events, but I also like the convenience. I was built to work from home. That's for sure. Okay. Awesome. Robert, look, it's been super fun having you on. Thanks so much for making the time.
Yeah, I appreciate it very much, Jay. And by the way, I love your conferences. Hope you guys get back to doing the physical conferences soon. I want to join them. Even coming from Texas, flying all the way up to Canada, I don't mind. You've done a great job with those in the past, and I'm looking forward to us getting, that conference circuit back up and booted again.
Yeah, me too. I love hearing that. And yeah, we're coming back January back to Vancouver for the VRIC. So stay tuned.
Awesome.
As always, if you enjoy this content, please hit subscribe. I'd love to have you on the team. And if you want to take the next step and go a bit deeper with my content, I publish a free weekly newsletter every Friday where I debrief my portfolio. I distill the top lessons I've uncovered from the guests I've had on this show every week. And I talk about sectors and industries that I think are poised to move, areas that I'm looking for opportunity, and places that I'm allocating capital. I love writing it. We publish every Friday. The link is right beneath this video. Love to have you join the tribe.